Hey everybody, this is Zach Casteros of Prime Locations, and we just published our first market report of 2017. And along with the market report, we always like to provide an investor lesson as well. We normally do it in the form of another article in the market report. But this time we thought we'd shoot a video and have some presentation slides to go along with it because the subject matter is a little bit more complicated. And I think it's a little bit more, it's a little easier to follow and understand if you're kind of watching a video and following along as I go. The question that we're going to tackle this time is really all about interest rates. For the first time in almost a decade, we're seeing rates starting to go up, and so the big question that everyone has, and the question I keep hearing asked as I go to forums and I'm online and I'm doing my daily job is, as interest rates go up, does that mean cap rates are going to go with them? Do interest rates rising mean cap rates have to rise too? I've heard it multiple times, and I thought, let's just shoot a video and tackle the question because I think it's a little bit less black and white than people want to think it is. And so if you're not familiar with a cap rate or you need a quick refresher, really simple. I'll give you a really easy way to think about it. The way I like to think about it and explain it in the most simplistic way is if you have some money to spend, let's say you have $1 million and you want to earn 7% on your money, that means you have to get $70,000 in return, right? And let's assume that your $1 million you wanted to go pay cash for a property, right? And you wanted a 7% return. It means the net income from that property has to generate $70,000 a year for you to earn 7% on the $1 million you put in, right? So it's just the income, the net income that the property generates divided by the rate that you want to basically realize. That's your cap rate. And so in commercial real estate, cap rates are what really drive valuation. There's some other things too, but for the most simplistic way to think about it. And so this is all about, as interest rates go up, does that mean that cap rates have to go up with them? And I'm going to talk about why that matters and what the consensus is and where maybe that might be a little short-sighted. And we're going to go through and tackle that. So let's jump right in and let's figure this out. So here's what we're going to cover. What are interest rates doing today? Because there's a lot of stuff going on, and it's important to know what they're doing and what's expected. We're going to talk about what are cap rates doing, right? Cap rates are fluctuating, not daily, but they're fluctuating probably year over year, quarter over quarter, and so what are they doing? And then, like we said, what do rising interest rates mean for cap rates, mean for the market, mean for prices? We're going to talk about all that, and then what should you do about it, right? And so when we talk about what rates are doing today, both cap rates and interest rates, after almost a decade, for the first time, we're seeing rates go up. They've already raised the rate, I think, twice now, and they're talking about possibly 2 more rate raises than 2017. We see, so that's on the interest rate side. With the cap rates are as low as they've basically ever been. Basically back in 2017 when cap rates were crazy low. We're basically back to that place. So that means that as cap rates go down, that means people's return requirements go down, because usually there's more competition. So what does that mean? It means prices go up. So we're at this weird sort of intersection between prices being kind of abnormally high and now interest rates starting to go up. And so there's where the big question comes in, is as that happens, right, does that mean that prices are going to have to come down to absorb the increased cost of capital? Right? And so what I want to do is I want to explore the issue and then go through an example, because I think that's the easiest way for people to follow along. So most answers that I hear to this question are just incomplete at best, right? They look at it through strictly a real estate lens or strictly a local lens, and obviously this is a big, complicated question, and we're going to tackle a little bit of that because I think it's cool to just know it and understand it. They look at it too simplistically. It's when this is not just a real estate issue. You've got to take in consideration the entire a broad investment market to really, I think, answer this question adequately. But I will say most people think the answer is yes, that as interest rates go up and the cost of capital go up, that definitely cap rates will go up with them and prices will come down. And I think that it makes really common sense to think that way. And I think in most instances it probably is the case. But there are times, which we'll talk about, where that may not be the case. So let's look at an example. Let's go back to this idea of you have $1 million that you want to spend on a commercial property, let's say, and you want to earn 7% on your money. And when I mean that, I'm talking simple return. I'm talking annual cash flow as a percentage of what you're putting in, okay? Because we're not going to get super complicated here. So you got $1 million, you want to make 7% a year on your money, and you're willing to use up to 75% leverage. And what I mean by that is if you had $1 million, you would and you wanted that to represent 25% of a total investment, that means you could actually afford a property of $4 million, right? You'd have a loan of 3 and your million as 25% down, and that means you could buy a $4 million property. Pretty simple. Okay, now let's assume that property that you found generates $270,000 in net operating income. That's your income minus your operating expenses is your net operating income. Okay, that would be a 6.75% cap rate. You divide 270,000 by 6.75%, you get $4 million. Got me? Okay, now your debt service, the $3 million loan that you got, let's say you got it at 4.5%, and let's say it was amortized over 20 years. You might get it over 25 or 30, and that'll change the net numbers a little bit, but let's just assume it's a 20-year am. And so your cost of debt service every year is about $200,000. Right? That's what your mortgage payments are. So you take your 270 minus your 200 and you have 70,000 left, and voila, you've hit your mark, right? You've got a property that's going to return you about 7% on your invested capital every single year, and it's going to grow over time. But now, right? Now let's say that the interest rates are going to go up. And when you thought you could get the loan at 4.5, it turns out it's really going to be 6.5. And so you got the same term, the same 20-year term, at now a 6.5% interest rate and the same $3 million, and all of a sudden your annual debt service is $240,000. That's a problem because now your cash flow went from $70,000 down to $30,000, which means you went from a 7% simple return to a 3% simple return. So what do? Obviously, you got to get the property at a lower price, or you have to be okay with making less money. And that's why people think that if interest rates go up and the cost of capital goes up, that cap rates have to go up with them, because you would have to pay a lower price to get the same return on the same piece of property with a higher interest rate. But that's not the whole story, right? And so let's just keep going through it. It's just not the whole picture. You also have principal reduction and depreciation, which if you're paying your mortgage down by, let's say, another $30,000 a year, that represents a return, right? You also have depreciation, which means you get to take non-cash expenses against your income on your tax return to also save money, right? And so those have to be added into the equation. And then you also have to look at the internal rate of return, because as your net income is growing year over year, the value of your property, because of how cap rates work, is also growing with them. And so if you were to dispose of your property 5 years later, the value is going to be higher. And so you'd have to take that appreciation into consideration with regard to your returns, right? Pretty simple to understand. And there's more things too. But nonetheless, on a simple, if you look at it simplistically, the fact of the matter is, as the cost of capital goes up, if you're using that capital, your returns have to go down, or you have to get a lower price. But let's think about this. In 2007, okay, we had cap rates that were about as low or lower than they are now. So prices were sky high. We had interest rates 2 to 2.5% higher. Both corporate interest rates, corporate bonds, treasuries, everything was 2 to 2.5% higher, and yet prices were as high in terms of cap rates as they are today. Well, how could that happen if this is not something that, if cap rates have to go up as interest rates go up? Well, that wasn't happening in 2007, and you might argue, well, it didn't turn out very good, and that could be a really good argument. But my point is that it's not as black and white. I don't think we can just make the blanket statement that the cap rates going up, or excuse me, the interest rates going up will definitely mean cap rates are going up. So we have to look at the broader investment market. And what I mean by that is these investment markets, they don't run in parallel. It's not like the stock market and the bond market and the real estate market and the commodities market are all running in parallel lines. No, what they're doing is they're all running in intersecting lines. They're all tied together and crossing over. And so it's those very things, right? Those very intersections that are really what drive pricing. And that's in the stock market, the bond market, the real estate market, and every other market. And what I mean by that, it's all about competition, right? So all investments, I don't care what you're looking at, all investments compete with each other. The stock market competes with the bond market, and the bond market competes with the real estate market, and vice versa. And the total amount of money that's available has to pick between the available investment options, right? So like what we've seen, we're looking at what's the best place to get the highest risk-adjusted return. Why do you think nobody's really been interested in the bond market for the last decade? Because while there may not be much risk in a U.S. Treasury bill or a Treasury bond or whatever you're going to buy from the Treasury, it doesn't make you any money right now. You're not even keeping up with real true inflation. And so money that was normally in the bond market and is normally in the bond market, not all of it's in the bond market. So what happens? It ends up in the real estate market and the stock market. And what do you see with real estate prices and stock prices? They're as high as they've ever been, right? And that's because the competition, right, the available money to be invested has been flocking to these markets, flocking to where the risk-adjusted return is better. But what happens with that is you end up with booms and busts, right? You end up with the situation where eventually so much money is in those markets, as we're sort of looking at now, where people start to say, are we in a bubble? Are we pushing prices so high and returns so low that eventually it can't be sustained? And that's a great question to ask. We're going to keep going on that. Real estate, bonds, equities, last 10 years, real estate and bonds have dominated, real estate and equities have dominated your stocks. Your bonds have really struggled. And that doesn't mean people haven't made money in bonds. People can make money in every market at any time. It's just there's less people in the bond market, right? However, that gets me into my next point. You also have to take into consideration the total investable capital, right? How much actual capital out there is to be invested? Because if capital, well, I don't want to skip ahead. So let's keep going on this. More capital equals more competition, which equals higher prices, right? More capital available. Right now, we have more capital available than we have assets to buy in the market, good assets, right? And so what you have happen is all this capital is out there. It's all able to be invested. People are finally making money. They've been making money for years. They don't want to invest in some things. They want to invest in other things. There's more competition in those things. Prices go up, yada, yada, yada. But we get to the point where you have to choose between whether you want lower returns or you want to buy riskier assets or you don't want to do anything. Okay, so let's take this example. Now let's say you're in the real estate market and you're saying, I don't know, prices for these commercial, let's say apartment complexes in Seattle are so high, I don't know how I would make money. And so I don't really want to make less money, so I don't want to invest in Seattle. So I'm going to go down to Thurston County. I'm going to go down to Olympia. And that is inherently a little bit more risky because it's a slower market. It doesn't evolve as fast, doesn't grow as fast. And so I end up either having to go into a riskier market, right, on the broad spectrum, or I can just sit there and do nothing. Maybe I go buy a bond, right, because the stock market's up there too. And so that's what we're seeing in action right now. This is literally what's happening. And so what we also notice is that major institutions are honestly the ones that drive most of the pricing, because the major institutions are the ones paying, 3 caps for apartment complexes in Seattle, or they're paying 4 caps for office parks in Seattle, and that's setting the market, right? That's taking the smaller investors and it's pushing them out of that market into other markets. But when they do that, it's also reducing the cap rates in those smaller markets, thus increasing prices. And it's the same thing in the stock market. You got these big institutions, they're managing billions and billions of dollars, and they're setting pricing, right? And so all those things you have to take into consideration with this question. And then the last thing on this point is your ability to invest without leverage plays into the equation. Because think about it, when it really all comes down to it, it's all really about your return on capital. And capital is debt and equity, right? And so when you look at the return on capital, if you're a big time investor and you don't need to use you don't need to use debt to buy property, your interest rates rising doesn't really mean much to you, right? So if you're still willing to go pay cash for a property at 5 cap, but somebody else would have to finance that 5 cap at 7%, they might not be able to buy it, and you still can. So that also has an effect. Okay, the last thing, and then I'm going to wrap this up. The velocity of available capital to invest, in my opinion, is the biggest factor. It's more important than competition. It's more important than the total amount. Those things all kind of play into this one, but it's the velocity of capital. And so here's what I'll say to that. Think about this. This is the situation I think we're at today. As interest rates are rising, that means bond prices are rising. That means that some people who've not been in bonds because they've wanted to go into these other areas, real estate, stocks, they're going to start saying, okay, well, these now are looking a little risky, so I'm going to put some of my money back into the bond market, right? And so inherently you would think, well, if that happens, there's going to be less competition, so prices are going to go down. However, and this is the big however and the big caveat, if The velocity of available investable capital grows faster than the exodus of those dollars to that other market. If we have more available capital to invest, and it grows faster than those dollars move, it really won't matter. Because as you have this, let's take a pie, right? Instead of, we're talking about the difference between taking one piece of a pie and making the whole pie bigger, right? If the whole pie gets bigger and we can't develop assets that are investable fast enough for those dollars to go into, even if some of those dollars are flocking from one investment to another, right? From one asset type to another, if the pool of total dollars is growing faster than that and faster than we have new assets coming in to the market, you're still going to have high prices. And that's why I think you can have situations where prices don't go down, where cap rates don't go up just because interest rates go up. Because if that velocity is happening at a rapid rate, there's still going to be investment dollars out there. Those investment dollars are still going to be out there flocking to good investments. And there's still going to be competition, so the prices are still going to be high. Here's the big caveat, and here's a big difference that I see, at least in our local market here, this time versus last time, and it's this. The velocity of dollars, I don't think anybody can disagree. People are making money again. The velocity of dollars, there's still money sitting on the sidelines. I think that's not going to stop. I think the big caveat to all of this is, do we get to a point where we oversupply the market again? Because that's what really led to the crash the last time. I mean, aside from the fact that people were getting loans that shouldn't have, but ultimately, like, we had way more single-family home production than we could actually ever supply the demand for, right? And that is simply not the case in our local market right now. Right now, we don't have enough supply, with the exception of the office market, to really meet long-term demand. So here's what I would say to all of what I've just talked about. If you get to a point where you start to see us create more supply than we can actually provide demand for, then I think we're in for a dangerous situation. But until that happens, I think that interest rates going up are just the normal course of business. I think there will still be competition. People will still make money, and they'll still want to invest in commercial property. And so I hope that was helpful. I think if you have questions, send me an email or find me online, Facebook or whatever, LinkedIn. Shoot me your question. If you want a copy of the slides, I'd be happy to provide them. And I look forward to a dialogue. Hopefully this investor lesson was helpful, and we'll see you next time on our next market report.